Look, first thing I do want to say, if I can, is congratulate Brett and Mel and the team there, Griffith, for putting on the symposium. I'm just a bit regretting I can't be there, but look, these things happen. But yeah, look, I want to talk about just very quickly about partnership income taxation regime in Division 5, a pretty standard regime, well known to everybody. And what I want to suggest really in this presentation is that, well, the allocation mechanisms really aren't that straightforward. So let's work our way through. First of all, I should apologise to the New Zealand people. Oh, can everybody hear me okay first? I guess I should ask that.
Yeah, you're perfect. Thank you.
Thank you. Great. Yeah, I should apologise to the New Zealand people and the Florida people and the Indonesian people, because this is focused on a regime in Australia. Look, the first thing I'd make in that handout there, introduction, background, perspective, is that some of you sitting there and listening to this will say, well, Dale, why are you wasting our time with this? What's the point here? A partnerships regime is well settled. It's there's nothing to get excited about. And the number of partnerships are going down every year. I think we're losing about 2,000 or 3,000 every year. We're down to about 300,000, I think it is now. And as you all know, the trust vehicle and the company vehicle keep going up. So when you sort of combine all that, I think there's a legitimate question saying, why am I spending time on this? Now, my response to that is, I guess we'll come through it hopefully in a second, that it's worth, trying to get on top of things, I think, to get things right if we can. The provisions themselves, very quickly, I don't want to bore everybody with this very quickly, but subsection 92.1 and 92.2. 92.1, very quickly there, in summary, the assessable income of a partner in a partnership includes the partner's interest in the partnership's taxable income. And section 92.1 uses the word net income, but it basically means taxable income. And subsection 2 is the opposite, and that is when the partnership has made a tax loss. That is deductions more than assessable income, and it basically says the part of a tax loss is allocated for the partner, and the partner puts it into their deductions. So, you look at those provisions and you first glance and you say, well, what's the issue here? It's pretty clear what happens. You pretend the partnership's a taxpayer, work out the taxable income or tax loss, and then we just allocate it out to the partners. So that's pretty standard, and we've been doing that for years. There's no problems there. So, Dale, what is your issue, basically? Well, if you flick over, when we look closely, a little bit more closely at those mechanisms we just looked at, you'll see on the express words, it's basically saying a partner has an interest in a tax concept. It's basically saying a partner is going to be allocated their interest, their part of the taxable income or tax loss, based on their interest in taxable income or the tax loss. Now, you all know as well as I do, but taxable income is not money, it's not profit, it's not property, it's none of those things. It's not something I can sort of, as an amount, go and say someone hand me over my part of the taxable income. And so, taxable income obviously is key in measuring a tax liability, and a tax liability is money we have to send in to the government. So that's real money. That's property and all that sort of thing there. There's no problem there. But as the Asprey report said, taxable income is just a figure. It's just a figure to work out a tax liability. And it's not on the handout here, but I think the Zetaforce case in 1998, in the context of trust, basically said that taxable income is an artificial thing. It's artificial. It's not real. So that's where my problem is. And by the way, on that last bullet point there, when net income in section 92.1 does mean taxable income. It doesn't mean accounting profit. So let's be clear on that. Okay, so that's my problem, basically, I think. So what are we, if we move on to the next slide there, basis or guide for solution? Well, I think the bottom line is we all sort of know that the tax law sort of operates on the general law effect of transactions. And, the judges lately have been using this statement quite a lot. The idea they talk about the taxable facts and the taxable substratum that the tax law, operates on. And, we've got plenty of the partnership cases where the judges say that Section 92 does respect the general law of partnerships. So given all that, I think we do need, when we're interpreting and applying Section 92, I think we do need to be aware of the general law of partnerships in terms of partner entitlements and partner obligations to meet losses, that sort of thing. So that's the background, I think. I think that's a basis for going forward. My suggested approach, and by the way, I'm being a little bit, I'm overclaiming here that's my approach, because it's not really my approach, because it's really the Asprey report approach, and I'll come back to the Asprey report. It doesn't go into the detail I'm going into here, but it's basically the same thing I'm saying. So I really shouldn't be saying this is my approach. But I think there's 4 steps in Section 92.1 and 92.2. First is establish the accounting position of the partnership, work out if it's made a loss or a profit for the year using accounting rules and all that sort of thing. The second one is to allocate the accounting position to partners, because that's what the partners want. They want their money. We've made a profit, give me my money. In that example, let's say partner A has 30% of the profits. The third step is work out the tax position. And that's what Section 90 says. Pretend the partnership's a taxpayer, work out the taxable income or tax loss using the tax rules, of course. And the fourth one is basically to allocate out the taxable income based on the entitlements to accounting profits of the partners, entitlements to accounting profits, or the obligation to meet the burden of losses. So that'd be my 4 steps in Section 92. And as I said, even though I'm saying I don't really think they're just mine. They're Asprey report, really. That's what they're saying. Let's move forward on the same handout, suggested solution or approach. I guess in a nutshell, what I'm saying there is that approach, that 4-step approach, gives effect to the idea that the tax law operates on the general law transactions. And it recognises, I think, the fact that you can't really have an interest in a tax amount. You can't really have an interest in a tax amount, a taxable income, etc. So that'd be my suggestion there. So if we just move on to point number 5, some observations. Let me move through these quickly because, I think everybody knows really what I'm talking about here. The first one is that my 4-step approach doesn't contain the express words. Section 92 doesn't contain the express words to support my 4-step approach. In other words, it doesn't have a bridge from accounting entitlements or accounting obligations, economic obligations, across to the tax position. Now, you will know that the second point on that slide is in the trust area. Basically, what I'm suggesting in the partnership area is exactly the same as the trust area, except the trust rules, Section 97, 98, etc., they sort of set out that 4-step approach in express terms. It's actually expressly stated. Your entitlement to accounting is what gives you your allocation of the tax position. I mean, that's essentially what it's doing there. On the third point there are numerous comments in the Asprey report which basically, I think, support what I'm saying. Or the other way around is I'm supporting what the Asprey report is saying. No need to go through them in great detail, but you can quickly look at the sub bullet points there. The first one is that the report notes the difference between accounting profits and taxable income, and notes that they can be different, of course, for a year. If you turn over the page, the first one there is they've already noted taxable income is merely a figure. The report notes that we don't tax accounting profits, we tax taxable income. And the report notes in that third bullet point that, we don't really have to work out when partner entitlements are expressed as percentages or fractions, and we don't really have to waste our time with accounting. We actually don't have to work out the accounting position. We just go ahead and apply the fraction straight to the tax position. But they do note that last bullet point that when a partner has a salary entitlement, usually of a fixed amount, then we probably need to work out the accounting profit. Because why? Because salary is basically a profit allocation. In fact, a priority profit allocation, really. So a lot of the stuff there, I'm just parroting the ASPE report, really. That's the way I see it. Point number 4, I've still got a bit more work to do on this. Brett made the point this morning that the paper's a work in progress. This paper is work in progress. Even though I'm fairly advanced, I've still got to tick off on a couple of areas, including looking at some of the board of review cases on partnerships. But the point I'm making there in point number 4 is that the court cases, the judges, they jump from the tax position to the accounting position as if they're one. They don't really distinguish between the two. Now, in fairness to the courts, they're not asked to, in the cases, Roe and all those cases, they probably weren't asked to make the distinction. So, why should they? But that's really what's happening in the cases. And point number 5, the Australian textbooks. Look, I haven't looked closely at the more recent editions of the Australian textbooks for our tax courses at universities, but they're basically silent. I think they're silent, and they don't raise this issue at all. They sort of, I think they really just say go straight to the tax position and allocate the tax position. Now, that's a little bit of a worry to me. No disrespect to the writers of the textbooks, but the reason it worries me is because we have some comments there about talking about a partner salary, and it's sort of, again, I don't want to put words into people's mouths here, but it's sort of relating that to taxable income. But taxable income is not, it's not profits basically, and partner salary, as you know, is really, is coming out of, is a priority profit allocation. That's really what it is. Okay, that's enough on the observations. Now, I just noticed too, point number 6 really is, there's some observations here which should have been earlier in, should have been in the top one. But anyway, we can work through these quickly. Whatever approach is taken to section 92(1), its interpretation, it's got to be credible. It's got to be robust enough to cover a whole range of situations. Now, let me just throw one up at you, and I'm probably, Brett's probably pushing me for time, so I might even cut back a little bit on my explanations here. But just think about this position. Point number 1 there in bold. The accounting position differs from the tax position for a year. In other words, you've got profit for accounting, but you've got a tax loss. Or the other way around, a loss for accounting and taxable income for tax sort of thing. Now, I reckon we've got a massive problem here. My 4-step approach is not going to help. I don't see how it can be applied in any sensible way. And what I've suggested at solution A there, I've got 3 solutions, and I'll just run forward solution B and etc. And I'll push back the solution A. Solution A might be that, look, take the partner's interest in the accounting position that reflects the tax position, and then go ahead and apply the section on that basis. So a partnership with an accounting profit and a tax loss will look to the partner's burden for meeting the accounting loss, and then we allocate on that basis. Well, the short answer straight away, you can see, well, the problem is, well, that's not real. It's not real. The partnership does not have an accounting loss. So how can you sort of go with that solution? That doesn't make sense. So, if we jump to solution B, I won't go into solution B. It's got a problem basically. That's the bottom line. I'm going to sort of gloss over it very quickly, just in the interest of moving it forward. Now, we'll go to solution C. In that situation where your tax position doesn't match the accounting position, surplus deficit, one approach is to say, well, look, section 92 just can't be made to work. It's just meaningful. just can't be made to work in a credible or meaningful manner. In other words, the collective mechanism, which is what the partnership rules do, they collect the taxable income into a fund and then allocate it out. It just can't work. So what do we do then? Well, the only thing I can really see or suggest is that we take the partnership and the partners out of sections 90 and 92, push them back into the general provisions. And what I mean by that is that every transaction the partner goes into, we basically say, well, that's a joint receipt, partly by this taxpayer, partly by this taxpayer, off we go, you know. Now, I've got the point there. And so, in other words, all the general rules operate at the individual partner level. Now, you might be aware that that's effectively what the ATO does with second limb partnerships. That's what it actually suggests. Okay, 5 to go, Brett. Yep. Well, I think I heard you right correctly. Yep. I'll definitely make it. Yeah, so that might be the way around it. Now, and I've got the comment there, this may produce an accurate outcome, but I don't know if it can in all situations. And let me just give you the obvious point. What happens when the profit allocation are in a different ratio to the lost allocation? How are you going to translate that down to each transaction? I cannot see at the top of my head how it can be done, basically. So I reckon we've got a massive problem there, basically. I really can't see. And you know, the rules have got to be able to operate, basically, somehow. So let me just keep moving on there and leave you with that. I'm not here to solve every problem. Oh, and by the way, at the top of that next slide, I've got the comment that just because the partnership regime can't apply, it can't be interpreted as an exclusive code, and therefore we should be able to go to you know, outside section 92 to tax partners on transactions. Income equalisation clause, look, I won't say, I'm going to sort of push pretty fast through this. One observation is the so-called income equalisation clause. They're more common in the trust area, but they're also common. They can be common in the partnership area. The idea there is the accounting profit is deemed to equal the tax position. That's really the accounting profit or loss deemed to equal the tax position. Over the page, I won't say too much here. Basically, the point is an income equalisation clause could fix up the problem I just canvassed, but I'd suggest to you in that second sub-bullet point, I don't know if it's going to fix it up in all occasions. I'm going to leave that little point with you. Partner salary, very quick observation is that my approach, this 4-step approach, I think gives better effect to the partner salary situation. I'll leave that there. I know I'm making hit and run comments, but I think my approach rather than well, I don't know what the alternative interpretation is to my approach or the ASPE report approach. So I think it better accommodates partner salary. Streaming, again, not raised. I won't say too much here, other than to make one very quick point, and that is, I cannot see how, if streaming is permitted through a partnership to allocate particular receipts to particular partners, if it is, I lean towards the idea that it probably is. It requires an analysis of the partnership accrual rules for partners and all that sort of thing. I cannot see how streaming can be accommodated other than adopting my 4-step approach. And last point, the interest and partner capital accounts. Don't want to say much here at all. That's a separate topic in its own right. To me, it's a real mess there. But one thing I do take out of what Justice Taylor said in Bevel is that I think the focus is on the partnership accounting profits. I think there's enough comments there to justify that, I think, which is what my approach is, the 2-step approach in effect. Entitlement to profits governs the allocation of the taxable income. Last point, conclusions. Look, I don't want to say anything. Brett, have I got one more minute? Just half minute, or if I haven't, I'm more than happy just to leave it there. You can see essentially what my conclusions are. I think the provisions you know, would be good to have them more expressly stated, I guess. But I'd be arguing for my 4-step approach. But be aware, it's not going to solve everything. I know I've pointed out a couple of situations where, you know, we really do have problems of applying those provisions. Thank you. There's a little bit more work I need to do to, especially the board of review decisions, because some of those board cases, really good analysis in some of those cases, and we might find in those cases that a board member has actually given us the pathway forward and all that sort of thing. Thank you for your time, and yeah, we'll see you later.